All right, we're going to go ahead and get started. So this week is bonds, and basically the structure of the two classes is today we do the fundamentals. So part of your homework for today was to look at the pre-read slides, and then there were a couple of questions in my finance lab that were geared towards having you make sure that you understood the basics of the slides. So you've had a little bit of exposure to what is a zero coupon bond, what is a coupon bond, kind of the basics of what do the cash flows look like. So we're going to work that through today. Make sure you understand the basics of them. For both of the remaining topics, bonds and stock, what's happening is that it's a very specific investment security that has a set of cash flows, and the way we value them is as the present value of those cash flows. So understanding what the cash flows are and then figuring out how to get the present value of them is essentially what we're doing for the rest of the semester. So the question to the is the final cumulative is basically we're doing the same things we've been doing. So yes, it's completely cumulative. There are a few questions on the final that are actually, we pick up 2 or 3 of the midterm questions and put them on the similar questions on the final. But most of the final is bonds and stock, but it really is the exact same timelines that you've been doing. So we're going to work our way through the basics of bonds today. And then what we do on Thursday is look at how they behave. Look at what happens when interest rates change. What happens when you get closer to the maturity of the bond. How do different kinds of bonds behave when interest rates change? So the goals today are, we're going to take a look. The first day of class, we talked about financial markets. We're going back to them today. The financial markets are the competitive market. So if you go back to the whole valuation principle thing, this is where you get the price of a bond. This is where you get the price of a share of public stock. And that is the competitive market price for a bond, because bonds are inversely related to bond price, and the interest rate is inversely related. Think about what happens when you have, think about the present value equation. Present value is cash flows divided by 1 plus R. So you have an inverse relationship between the present value and R. So the fact that you have a competitive market price for a bond in the financial market means you also have a competitive interest rate. Then we'll talk about the cash flows of a bond, make sure everybody understands the terminology, and we'll work through the mechanics of actually calculating the price and calculating yield to maturity. So one thing to start being aware of here is that as we move into different kinds of financial instruments, the words that are associated with R are unique to each instrument. So for a bond, we talk about the yield to maturity. That's R. That's your return on the bond. Your yield is your return. When we get to stock, we'll talk about the cost of equity. That is the return that equity holders expect on stock. So getting used to the words makes it easier to do problems on an exam. Okay, so financial markets. If you got online, one of the things that you would be able to do is look up the price of a bond. The reason that you can look up the price of the bond is that there is a very active bond market where these are being bought and sold. If somebody thinks they're overpriced, they'll sell them. If somebody thinks they're underpriced, they'll buy them. And the fact that there are a lot of people trading these establishes a competitive market price. So one of the things that happens is that a lot of people trading means that there's liquidity in the market. If you're holding bonds and you want to sell them for cash, it's easy to do. You just get online and you do it. If you want to know what your bonds are worth, even if you don't want to sell them, but you want to know what they're worth, you can go online and look up the price, and it lets you know what your portfolio is worth. In the case of the bond market, it also gives you interest rate information, because if you know what the bond is worth, you also know what the yield to maturity is. And we'll be talking about yield curve in a few minutes. In the stock market, it lets you know not only what the price of the individual share of stock is, but if you go back to what we were doing on Thursday, if you know what the the value of one share of stock is, and you look at how many shares of stock there are in the entire company, you know what the market thinks the value of the equity in that company is. So gives you lots of information about what is the competitive market valuation of bonds and stock. There are a lot of different financial markets. There's a stock market, there's a bond market. When you travel and you change from one currency to another, the fact that there is you know what the exchange rate is because there's a foreign exchange market. There are commodities markets. There's prices, when you read about the oil price, that is because there's a market for oil, there's a market for corn, there's a market for hogs, there's all sorts of commodities markets there. There are things called derivatives, which you may or may not end up studying. If you do more finance courses, you may study them. But a derivative is something like an option or a forward or a future or a swap or something like that. They derive their value from a different asset. Those last three things are beyond the scope of what they're doing, but they are also financial markets. For purposes of this course, we are looking at the stock market and we're looking at the bond market. So today and Thursday, we will be doing the bond market. Next week, we will be doing the stock market. And then the following week on Tuesday, we will do a mix of wrapping up some of the stock market questions and spending time going over all the questions that you're going to need to know for the final. And then the final is Wednesday of that week. So that's what the rest of the course looks like. So issuing bonds is one way in which companies and governments can borrow money. So a bond is debt, and they get traded on the bond market. When you issue a bond, what you are doing is selling your debt, and you owe the bondholders money. So when we think about this diagram that we did last week, and we talked about how you have everything you own, and then the other side of your balance sheet is how you paid for it, and you paid for it with a mix of owners putting their money in and borrowing money. Bonds is one of the ways in which you can borrow money. So big picture here, bond prices change based on market conditions, and they change frequently based on market conditions. They can change every minute based on market conditions. So if we go back to the present value equation, so think about your present value equals C over 1 plus R to the N. If rates change, present value changes. So in the bond market, the present value is the price and R is the yield. Those can change. The cash flows do not change. The dates do not change. These things here are all set the day that the bond is issued, and they don't change. So as conditions change in the market, these bonds can be out there for 20 years, and interest rates change a lot in a 20-year period. So as conditions change in the market, the only way that an investor's yield can adjust to new market conditions is because the price on the bond changes. So what I'm going to do for a moment here is show you a picture of a bond. Give me a moment. Where is my... There we go. We have one that's in the slide deck, but this one's a little bit more fun. So let me switch to this. Okay, this is an actual bond. And the reason it's a little bit fun to look for, partially it's fun just because it's fun. It's JCPenney. And what we're going to talk about when I say that payments don't change, cash flows don't change, maturity doesn't change. If you look up at the top of that bond, I should make this a picture that I can draw on. So I can point to what I'm telling you. There we go. Now I can draw on it. So if you look up at the top of this bond, that 1,000 is telling you that that's the face value of the bond. So when you went through the pre-read slides for today and the problems that you did in my finance lab, one of the things you know, and we're going to be working through this a lot more today, is that the structure of a coupon bond, and these things are the coupons, is that you get paid the face value at maturity. So at maturity, you would get this $1,000. These things, each one of those is $22.50. So you would get, if we turn this into a timeline, you would get $22.50 at each of the coupon dates. And then at maturity, you would get that $1,000 and you would get the last coupon, $22.50. And the date, the final date that you would get these things is July 1st. I think that says 1994, not sure. 1994. So one of the reasons for sort of playing with the visual here is that this all gets printed. This gets finalized when the bond gets issued. So there's no way that any of this can change. Every single one of these things is set the day the bond is issued. So the only thing that can change when market conditions change is the price and the yield. And because investors are not going to buy something where they don't get the competitive yield, the price has to change in order to make sure that the investors get their competitive yield. So the financial market is the driver of this process. So the one other thing I will tell you while we have this out here is that these coupons, so what used to happen, I mean, now this is all electronic, but what used to happen is you would literally take out your pair of scissors, the date that this coupon was due, you would cut that off, you would walk into the bank, you would hand it to the teller, and the teller would hand you $22.50. So the reason they're called coupons when we get to doing the timelines and stuff is because these literally were coupons that you cut out. So there's a historical reason for the word. All right, back to our slide deck. There's a picture of a bond in the slide deck too, but it's not quite as much fun. All right, so we will come back to this fundamental concept here, but it's important as you're working through it that you have this in the background the entire time, that the maturity date, the payment, and the face value that gets paid at maturity, those never change with the bond. So here's another picture of a bond. All right, so bond terminology. We've been talking about what a bond is. It's debt. The certificate is the terms of the bond. So it's a legal document that is set when the bond is issued. And it says, among other things, it has covenants and other things in it. But included in this certificate are exactly what payments and exactly what dates when the payments are going to be made. So the payments in a bond are the coupons that get paid periodically and the face value that gets paid at the very end. So one of the things we're going to be doing today is working out the timeline and making sure that you understand exactly what goes on that timeline. And basically, when you have a coupon bond, because the coupon is the same thing, what you have is an annuity. So once you understand the structure of it, what you're doing is you're using these keys on your calculator to calculate the value of the bond because it's an annuity. The maturity date is the final date when the face value gets paid. And the term is the length of time before that maturity date. So there are two, face value. I showed you the picture. It's called face value because that was the number that was on the face of the bond. So we talked about principal in loans. The principal in a loan was the amount that was owed. So the face value is the principal. It's also called the par value. It is the amount when we calculate the coupons. When a coupon is a 3% coupon, it's 3% of the face value. So you use that amount to calculate your coupons. Usually these things get issued in standard increments. So like 1,000, 10,000, 100,000. And for purposes of this course, we're teaching you a very basic form of a bond. There are variations on these things, but for purposes, you can take bond courses later and learn a whole lot more about some of the other ones out there. But for these purposes, the face value is what gets paid at maturity. And then the coupons are the name for these payments, these periodic payments. And sometimes they're once a year, sometimes they're every 6 months. So what's going to end up happening is that we're going to take the period of time. The coupon rate is going to be an annual rate. And if we have a semi-annual coupon, we'll divide it in 2 in order to calculate what the actual payments are. So what we're going to start with is zero coupon bonds. And zero coupon bonds are exactly what they say. They don't have a coupon. So the only cash flow in a zero coupon bond is what you pay for it when you buy it and the face value that you get at maturity. So we're talking about a very straightforward timeline here. At maturity, you get the face value, and today you pay the present value. So you buy it, and then you get the face value at maturity. You might not end up holding it into maturity. You might actually sell it before maturity. So if you sell it earlier, then you'll get your cash flow earlier. But the company doesn't, or the government, whoever issued the bond, doesn't pay it until maturity. One of the things that we will focus on is US government bonds, because as we look at interest rates in the market, one of the key concepts is something called a default-free rate. And what a default-free rate is the rate that the market expects to get, the yield that the market expects to get, if there's no risk that it's not going to get paid. What we'll talk about at the end of the day on Thursday is corporate bonds where there's some risk that they won't be paid. So then you pay a premium, what we call a credit spread, on top of the default-free rate. But learning about the basics of bonds, everything we're going to do up until the end of the day on Thursday is looking at what we call default-free yields. And generally what the market does is they look at US government bonds to figure out what the default-free yield is. So for zero coupon bonds, they would use treasury bills, which are zero coupon US government bonds with a maturity up to a year. All right, so get your calculators out. Time for you all to start working here. So what we have here is a 1-year zero coupon bond. It has a $100,000 face value. So that's on your timeline 1 year from today. We're going to pay $96,618.36 for it. So if these are your cash flows and the maturity is 1 year out, what is solve for R? What is your yield? And put it in the chat box. There you go. So one of the things you want to be doing as you're going along here is saying, oh, I already know how to do this. You really want to realize that every single thing you're doing is something you've already done. So you want to be able to execute it in a new concept, in a new context, but make sure you're really rooting it in the experience of something you've been doing over and over and over again for the past 3 weeks. All right. So if you wanted to think about the formula, and it really makes more sense to do it in your calculator, but what we just did was said that the face value divided by the price, in this case, N was 1, so you didn't have to think about that. That would be how you would calculate the yield. That's exactly the same formula that you've been using. So we had you do this calculation. I have you do it before I show you the slide because I'd much rather have you realize that you totally know how to do it. So now what we're going to do, the one I just gave you was, here are the cash flows, what's the yield? Now what I'm going to do is tell you that we have a $100 face value bond that is a 5-year zero coupon bond with a 5% yield to maturity. What is the price? Excellent. All right. So one of the things about zero coupon bonds is that for the moment, there's really nothing more to say about them, but we've only been talking about them for about 3 minutes. And the reality is you don't learn anything in 3 minutes. So you have to do it in order to learn. So what we put in here, we do this both with zero coupon and coupon bonds, is a drill slide. And what we're going to do, it's the next slide, so give me a moment. What we're going to do with this slide is push you to work on doing things efficiently when they're not all that hard. So yield to maturity of these 3, put them all in the, and I'm going to give you 1 minute each. So 3 minutes to get all of these into the chat box. Okay. So you all just did all 5 of those in 3 minutes, which is important for you to realize because I think you feel like you're under a lot of time pressure, but you actually are doing this stuff way faster than you need to be able to do it for the exam. So the thing to do is just keep doing that. it's repetition is where you get the ability to do this stuff. So before I move on, anyone, I know a lot of people posted the answers. So if anyone had any trouble, you can send it to me as a private chat or send it to Sarah, but I want to make sure we don't move on without people knowing how to do this. Sarah's nodding her head, so she may be answering questions on the side. Yes. Okay, awesome. Keep her working, guys. All right. So what we're going to talk about now is what we call the yield curve. And I'm going to show you a picture of it in the context of what we've been doing, and then back up to the words. But understanding what it is makes it easier to absorb the words. So I'm going to move forward to a picture. What you have been doing, without me telling you that this was what we were building towards, was actually those first two problems we did, we were plotting 2 points on our yield curve. So the second problem we did was a 5-year bond with a 5% maturity. So there is that bond right there. It is a 5% yield to maturity, and it is a 5-year bond. So here's our yield to maturity on the y-axis, and our actual maturity is on the x-axis. Then our 1-year bond, the first one we did, had a 3.5% yield to maturity. So what we're looking at here is a relationship between a 1-year rate that was 3.5% and a 5-year rate that's 5%. So what you're looking at is that investors in the market, if they were going to invest money for 5 years, were looking for a different yield than if they were going to invest money for 1 year. And there is generally a different yield at all different periods, and the relationship between those depends on other things going on in the market. So we're going to talk a little bit about that. There are a lot of theories about what this relationship is. So what we call this relationship is the term structure. It's a relationship between what is the interest rate at different points in time. And the yield curve is the graph that plots that relationship. And specifically what we're looking at, I mentioned this earlier, is the risk-free rate. We're looking at what is the curve here for money that can be borrowed or lent without risk over a given period of time. So the reason we're looking for risk-free rates is we're looking specifically for the relationship between what investors are looking for a yield at specific maturities. Once you start adding risk into the equations, there's other issues there. So what the law of one price guarantees here is that if you have two different securities that have, that you're getting the same cash at the same time, and there's no risk that you're not going to get the cash, then they have to have the same price. And if they have the same price, they have to have the same yield. So what we do is we call this the risk-free rate for that period. So again, this is how you would plot those two bonds that we did at the very beginning when we were talking about zero coupon bonds. Now, the actual shape of the yield curve varies. So if you looked at November of 2006 and plotted a range of rates from 6 months to 20 years, you would have gotten this blue curve right here. And in November of 2006, the short-term rates were higher than the long-term rates. In November of 2008, the short-term rates were significantly lower than the long-term rates. In November of 2007, they have this funky little hook thing here but then they eventually are higher. So rates, the curve has a different shape at different times. There are a lot of different theories out there for why curves look the way they do. They usually embody something of where investors expect rates to go. So if you think about what happens when you have expectations, let's imagine that you thought rates were going to be a lot higher 10 years from now. That would mean that if you were going to leave your money invested for 10 years, you would want to make sure that you were getting a higher rate, whereas you'd be willing to do it for a shorter amount of time right now. On the other hand, if rates were going to go down, if expectations were that rates were going to go down, then if short-term rates, if we look at this blue one here, if short-term rates are really high, the companies who are issuing these bonds aren't going to issue them long-term at those high rates if they think that the rates are actually going to go down, because they know they'll be able to issue, or they think they'll be able to issue them at lower rates in the future. So they'll be willing to do short-term stuff at this higher rate, but not the long-term stuff. That's one of the theories. It's called the expectations theory. There are other theories out there, and again, that falls into the world of things you'll study if you take additional finance classes. So these various curves here, this first one here is what would be called the normal curve. When people have, for one reason or another, if the rates, the long-term rates are much higher, it's called the steep curve. And when long-term rates are lower, it's called an inverted yield curve. So put your pencils down for a moment, relax for a moment. I'll show you this graph here. Just because it's a little bit fun, I have to shift the, all right, there we go. So what this is, this purple thing over here is the yield curve. So here is a yield curve on June 15th, 2020. Right now we have a yield curve where short-term rates are really close to zero and 30-year rates are, looks like they're a little bit below 2%. Over on the right, what we have is a graph of the S&P 500 going from 2000 up to 2020. And what you can do is you can click at any point on this graph, on the S&P 500 graph, and then over on the purple here, it's going to show you what the yield curve looked like at that point. So if we click over here, that's a pretty steep yield curve. That's an even steeper yield curve. That's a kind of flat yield curve. It's kind of flat. I'm trying to find you an inverted one. That one's a little bit inverted. There we go. Now it's getting to be a little bit inverted. Kind of does weird things when people are expecting the market to fall. Trying to find, back in last spring, it was inverted for a while. Anyway, those of you who think market stuff is fun, that's linked to that slide. You can go back and play with it. Those of you who think market stuff is absolutely horrible and you can't believe you have to take this course, but you're doing your best to survive it, you don't have to think that's fun, and you certainly don't have to go back and look at it again. All right, so the point here is that because of the law of one price, the competitive market is going to make it so that risk-free, zero coupon bonds at the same maturity are all going to have the same yield, because the interest rate and the price has an inverse relationship. What that means is that every time the price changes, the interest rate's going to change. Every time the interest rate changes, the price is going to change. So those are absolutely locked together. All right. So now we move on to coupon bonds. So just giving you all a sort of a check-in here. I am going to guess that we will finish up early enough that we can go over any questions people have on how to do problems on the exam. So you can kind of put those in you can think about that in the back of your mind for maybe the last half hour of class or something. Okay, so those were zero coupon bonds. Coupon bonds, in addition to paying the face value at maturity, also have regular payments. We call them coupon interest payments, but really what you want to do is just think of them as payments. They are cash payments. So for purposes of thinking about the default-free rate, there are two different kinds of U.S. Treasury coupon securities in the financial market. One is Treasury notes, which have maturities from 1 to 10 years, and the other is bonds, which are longer than 10 years. So if you're an investor and you invest in a coupon bond, you're getting your return from two places. You're getting your return from the difference between the amount that you pay. So you pay an amount right here for your price, and you get your face value at maturity. And the difference between those is going to be part of your return. Now, with a coupon bond, you sometimes pay more than the face value. So that return that's related to the difference between the price and the face value can either be a positive or a negative number. You also are getting these periodic cash payments. So those are set amounts that you're going to get, and those are going to add to this other number here. So you've got two different places that your return is coming from. So in order to compute the yield to maturity of a coupon bond, we need to know the face value, and we also need to know the coupon payments. And what's going to happen is, the way this is all going to map into what you've been doing, is those coupon payments are payments on an annuity, and the face value is the future value. So if you think about there was actually a problem in the exam which said you're going to get this amount of money periodically, and you're going to get this amount of money at maturity. So this is exactly the same cash flow structure as that problem that was on the exam. So the first thing we have to do is learn how to take the language in a coupon bond problem and turn it into the timeline. So some vocabulary here as a starter. One is that you are going to get a coupon rate. It's going to tell you something like, and it pays a 4% coupon. It's also going to tell you whether it's an annual coupon or whether it is something like a semi-annual coupon or a quarterly coupon. So when you read a problem, what you need to know is what is the rate and what is the number of payments in a year. What you're looking for is the actual cash amount, because that actual cash amount is going to be your annuity payment. So you take the rate, you multiply it by the face value. If you had so let's try one here that, make sure I don't use the same numbers that we're going to do on the next page. Let's imagine that we have a $10,000 face value bond, and we have a 4% annual coupon. What is the payment? Put it in the chat box. Good. Now let's imagine that instead of being annual, it's semi-annual. Now what's the payment? Exactly. All right, so now we'll stick that in a great big long paragraph. So what we're going to be doing for literally the next, this is slide 22, and we're going to be working with this same bond all the way up to slide 32. So for 10 slides, we're going to be working with the same bond. We're going to change the yield. We're going to do different things with it. But this basic cash flow structure that we're going to come up with is going to be the bond we're working with. So what I'm going to have you do is I'm going to have you get in the breakout rooms for 3 minutes and take a picture of this slide with your phone so that you have it. And what I want you to do is come up with the timeline for this bond. So this next slide here takes that paragraph and tells you which pieces give you which information. So what I want to do is make sure that everyone is really clear where this timeline came from. The goal of today is to get everyone to the point that the basic structure of a bond and how the values change when interest rates change is really intuitive. And the only way you do that is by getting out your pencil, drawing the timelines, putting the numbers in your calculator, and getting really close to it. So this phrase right here tells us that the face value is 1,000. And since today was January 2010, it tells us that we have 9 years left to maturity. 3% coupon rate and semi-annual coupons, that's what I was doing with you when I made up that problem on the earlier slide. That's where you get the information about how that it's going to be 3% of its face value, and there's 2 per year. So we're going to take 30, divide it by 2, and the individual payments are going to be $15 each. And then finally, because it's every 6 months, if now is January, July 15th is 6 months from January 15th. So this will be our timeline. And a critical thing to point out here, this is partially coming from some of the meetings, office hour sessions I had yesterday going over the exam, so I'll make sure we nail it right away, is when you are putting this in your calculator, your payment is 15. Your future value is 1,000. You don't add the $15 payment into the future value because this payment is already in the payments. When we tell it that N, so N is the number of periods. Again, go back to what we did when we were doing APR and, Matt, I'll be right with you. Go back to what we were doing when we did APR and EAR and things like that. We have to match the periods and the interest rates together. Matt, yes.
I just got like a quick question about like how much you're spending and how much you're getting.
Yeah.
When you pay that initial, like, I don't know, $1,100 for a coupon bond, do you get every coupon and the face value?
Yes.
So you can't really go wrong. You know what I mean? Like, can you lose in that situation?
I'm trying to decide whether to give you a complicated answer or a simple answer. No, you can't go wrong. Let me sort of explore a little bit why I hesitated. And we're going to do more with this on Thursday. So first of all, I want to be really clear here that what we're doing in this course is a very simple coupon bond. So any of you who are off doing internships with people who are doing intricate investment strategies, people create financial instruments by taking these bonds and separating out the coupon payments and the face value payments, but that isn't the structure of the bond. It's that somebody took it and created something different. So that's a whole world of finance that we are not dealing with in this course. But the fact that you can go find that in the market somewhere doesn't change the fact that when you buy this, this is what the legal document, the bond certificate, says that you're getting. Investment bankers love to get paid to do crazy things. And if somebody wants to buy it, they will sell it. So the other thing is, can you go wrong? The reason I hesitated is it depends a little bit on what you think of as wrong. So when you're investing, what you're doing when you invest in the market is you're trying to get a return. And if the competitive market return for bonds today, I'll make up a number, is 2%, then if you buy this package, and again, we're talking about default-free bonds, you buy this package, you will get your 2% return on what you paid for it. Now, if you suddenly realize tomorrow that you need cash and sell it, the market could have changed. The price could have gone down. If you hold it all the way to maturity, you will get this package and you will get your return. But what we're going to explore on Thursday is the fact that because interest rates change in the market all the time, if you sell it before maturity, you might either make a lot of money or you might lose money. So it's like any other investment. But as long as you hold it to maturity, you will get that return. So it kind of depends on what you mean by could it go wrong. Claudia, you had your hand up.
It's fine. I asked here.
You're there. Okay. So there's a lot of stuff that's really fun about bonds. The trick teaching it is to sort of have fun talking about it, but also not outstrip everybody's ability to absorb what's going on with the interest rate. So we're going to play a little bit. I have a Excel spreadsheet that will open up on Thursday and play around with what happens if interest rates changes, what happens with the different structures of bonds, so we can kind of play with it. But we're going to make sure everybody's got the basics down before we play too much. So Matt, you're totally on where we're headed on Thursday. So make sure that when you so what we're getting on the last day is 1,015, but the 15 is already in the payment. So your future value is 1,000. Any questions on this slide before I turn this into an actual problem? So what happens when we compute it? And before I switch to the next slide, what you've got here is an annuity, all right? So what happens here is that what we pay is the present value of all of the future cash flows. So a critical thing to be aware of from now until July 1st, after that you may proceed to forget everything until you take core if you so choose. And then you're going to have to remember it all again. Is that what you pay for a bond, what you pay for a share of stock is the present value of your future cash flows. The thing about a bond is we know what those cash flows are. It's different than the stock market. The stock market, we don't know what they're going to be. We just have to come up with a forecast that we might believe. But in the bond market, we know what these are supposed to be. And what we are getting is an annuity. And as you look at this little bracket here, this bracket is including that coupon in the annuity. So there's where that last coupon is part of your annuity. And we are getting the face value as a final payment at maturity. So we're going to pay the present value of the annuity and the present value of the face value at maturity. Now, we can do a great big long formula for that, but you can also put it in your calculator, which is way more effective. And what you're going to discover is that the calculator, thinking about the fact that when you have a coupon bond, you are going to use every single one of these keys, helps you organize the information. So use these keys as an organizational tool. You're looking at a problem, you're saying, how many periods are there? What is my periodic yield to maturity? What is my periodic coupon? What's the face value? So if you look at what I've done with this chart here, 3 of them have asterisks. All of those change if it's not annual. The face value and the price, those are fixed amounts at a fixed time. Those are just numbers. But all of those other things are going to get adjusted depending on whether it's annual or semi-annual or quarterly. All right. So with that information, you are now ready to try to calculate the price of this coupon bond. So this basically, sorry. If we give you the interest rate, you can calculate the price. If we give you the price, you can calculate the interest rate. 2 things here. One is that if you pay the price, it's an outflow and everything else is an inflow. If you choose to think of the price as a positive, then you need to make both the payment and the face value an outflow. So the payment and the face value are both cash flows that if you're investing in this bond, you're going to receive, and the price you're going to pay. So the other thing to think about for a moment here is that if we are calculating the interest rate, remember that what you have done is adjusted your N and your payment for the period. So when you get the interest rate, you need to adjust it back to annual. It is the yield to maturity is an annual number. So if you think of some of the problems on the midterm, what happened was that you calculated the problem, you got a monthly interest rate, and the problem asked you, what's the APR? So you took that monthly interest rate and you multiplied by 12. So if you get a periodic rate, you're going to need to adjust it to the annual rate. Yield to maturity is an annual rate. So one of the key things here is I could have taken every bond problem on the final exam, stripped the bond words out of it, and put it on the midterm, and you would know how to do it. There's absolutely nothing we're doing right now that you haven't done. All right. So put the answer to this in the chat box. Turn the recording back on. So we worked out the cash flows earlier. And what we do with those cash flows is 18 is going to be our N. 15 is going to be our payment. We're going to get 1,000 at the end. So that's going to be our future value. So we had all those numbers before I gave you a price to play with. Now we're going to say that the present value is the price that we're paying, and that's going to be 1038.82. You need to put it in as a negative because you're paying it. It's an outflow. And what we've done here is we've adjusted everything to 6-month intervals. So 18 was 9 years times 2. 15 was our $30, 3% of 1,000, divided by 2. And when we solve for I, we're going to get a 6-month interest rate. So we're going to have to multiply it by 2. So this slide is the neatly written bullet points that go with what I was just showing you. So the critical thing here in red is that everything is a 6-month interval. So because you've adjusted N and the payment to a 6-month interval, the I that you get is a 6-month interval. So you have to multiply it by 2. So now that we've come up with an answer to this, what I'm going to go back to is something that will hit everyone at some point. And that is the fact that I'm going to talk about the interest rate and the coupon rate. So let me go back to the description. There we go. So the coupon rate on a bond is the rate that is assigned in the bond certificate to be used to calculate the payment. That is a number. I'm watching the person who sent me the private message, and that person's nodding, so I appreciate it. Now she's laughing at me. I think I just called you out. Everyone is going to bump into this. I absolutely promise you. So what happens is in the bond certificate, it gets written and published with a coupon rate. And you use that coupon rate to multiply times the face value. And that tells you what your coupon payment is going to be every year. Because it's semi-annual, you have to divide it by 2, and it tells you that the payment is $15. So one of the ways to help you remember that that coupon rate is never, ever going to change is that if I take you, watch out, I'm going to spin slides here. If I take you back to our picture, one of the things, the visual that can help is these things are coupons. These things got printed on really pretty paper and expensive paper. They are not going to change. But the interest rate in the market is constantly changing. So the yield to maturity, which is going to drive the price of the bond, I'm giving you all a headache. I know, we're almost there. There we go. The yield to maturity, the interest rate, which is going to drive the price of the bond, is constantly changing in the market. If you set your cell phones to some financial news service, you're going to see the fact that when you read about how treasury yields went up or went down or did this thing or did the other thing, yield to maturity, interest rate, that is the interest rates associated with the bond market, and they are constantly changing. All right, so we just calculated the yield based on the price. Think about that first slide. I told you that the coupon, the maturity, and the face value never change. The price and the yield, you can calculate the yield if I give you the price. You can calculate the price if I give you the yield. So now we will do that. But before we do it, I'm going to point something out. in the last problem, we had, back up here, I've turned it into a complete mess, but we had a yield to maturity of 2.52%, and we were paying the cash that we were paying, the cash payment that we received every year was based on a 3% coupon rate. So we were getting cash that was higher than the market required. And the result was that our price was higher than the face value. What I'm going to do now is I'm going to tell you that interest rates are going to increase. The market is now going to require a yield to maturity that's a higher percent than we're getting as a coupon payment. We'll talk more about that, but I just want you to sort of be aware of that. So back to the math. Cash flows have not changed. What's changed is the interest rate, and don't forget to adjust your interest rate to a 6-month rate. So what's the price now? Oops, I moved this on you. Sorry, everyone. That was not helpful of me. There we go. All right, I'm going to put the price on this, and I'm seeing some of you have got it, some of you don't have it. So what I'm going to do is I'm going to put the price here. And I'm going to wait a minute and see if everyone can play with it and back into what they needed to do to get to the price. Even if you're not sure why you needed to do it, see if you can figure out how to get that number, and then we'll talk about it. All right, good job, everyone. Okay, so I think where people were coming up with 200s and 400s, what you were doing is you were multiplying the yield times the face value, which just doesn't mean anything in the bond market. So what happens here is our number of payments hasn't changed. Our payment hasn't changed. Our face value that we get at maturity hasn't changed. What's changed, our recurring theme in this world, is that the interest rate and the present value are the only things that change. So when the interest rate changes to 4%, the semi-annual equivalent, we divide it by 2 and we get 2%. So we put 2 into the interest rate, and then you press the present value button, and that's your price. Any questions on that before I? All right. So this is the slide that brings us back to that first slide, this relationship between the yield to maturity and the price. So what happens, again, think of my You know, I told you I was going to do that kindergarten thing with you where I said 1, 2, 4, what's the biggest number? And then I put them in the denominator and said, what's the smallest number? I said, I'm going to keep coming back to that. So here we are again. Your price, your present value is a function of our present value formula. And if the rate goes up, the price goes down. So our rate increased from 2.52 to 4%, and the price went down to 925.03. So what's happening here is that in a competitive market where the reality of the market is that interest rates are constantly changing. So if the interest rates are constantly changing, there would not be an active liquid market unless buyers could always get the market interest rate. And the way they get the market interest rate is by adjusting the price so that the price gives them the yield. So what happens is that a bond's price is constantly changing. Constantly. This isn't like once a week it changes. It's in this active competitive market. It is constantly changing so that the yield to maturity is whatever the current market interest rate is. So what we're going to do is have you practice three bonds here. So we're going to do these. Then we're going to do the practice problems for class 8. And then I'll give you a break, and then anyone who wants to stay and go over exam problems can do that. So what I've just posted here is the answer at the beginning, but also what the calculator inputs are to get it. So what I'm looking at from almost all of you, a number of people are fine. Most of you where it's off, a few of you did the 0.69 and forgot to multiply it by 2. A few of you actually came up with twice 1.386. So go back and look at your numbers and make sure you're comfortable with, and then I'm going to point something out about this. So one thing to observe here that we did intentionally is that this first bond has a 4% coupon and its yield to maturity is only 1.386%. So it is selling for more than the face value. The second one has a yield to maturity that's higher than the coupon, and it is selling for less than the face value. So both of these, you were calculating yield to maturity. The last problem on this slide, you're going to calculate the price. And one of the things you want to be doing here is actively processing, not just, oh, I did this wrong, I'm fine. that doesn't actually help you a lot. What you want to do is make sure that you really connect with what is the concept here and nail that down in your head. So this is what we're doing right now. Just drilling coupon bonds is a really useful exercise. So one of the things that's going to happen in the next 2 weeks, we spend a week on bonds, then we spend a week on equity. And what happens is, because notwithstanding the fact that there's a mix of who got these right and wrong, they're not that difficult. So what happens is you get through the bonds, you say, fine, I've got it. And then you focus on equity. And it's amazing how quickly you can forget something that you only did for a week. So one of the things that's going to really help you is to make a point between now and the final of every couple of days just doing 3 or 4 bond problems. And one of the things that you will find useful is to take some of the My Finance Lab problems. So remember what I told you about using My Finance Lab for a drill. Go in, get a coupon bond problem, and just do the similar problem thing like 10 times. And you can be doing it while you're listening to music. Like, you don't have to be overly focusing on it. It's literally, if you were a musician, like practicing scales or something. It's just, you want to keep your ability to quickly gather this information and remember how to get it in your calculator and do the problem. So that's a useful way to spend time. So the other thing we're going to do, let me stop the share on this. I'm going to open the Class-8 problems in Questrom Tools. So go ahead and log into Questrom Tools so that you can get to them when I get it open. All right, they are visible now. Go back to our screen share. Okay. These are the problems. The answer key is on the last page. Future value is 100. Present value is minus 97.22. It doesn't matter what the original number of years to maturity was, because now it's later. We're going to find out how much later. Has a 6% coupon. So 6% times 100 divided by 2 equals 3. Payment is 3. I is 8 divided by 2 equals 4. So put all of that into your calculator. You're going to solve for n, and you're going to get 3.00. That is the number of 6-month periods. So you have 3 6-month periods. which means 3 divided by 2 is 1.5 years. And for number 3, face value is 10,000. It's semi-annual coupons. Present value is minus 9,543.45. 2 years semi-annual means N is 4. I is 6.8 divided by 2. So we're going to solve for payment. And the payment is the coupon. And once we know what the payment is, we'll find out what percent of the face value it is. And that'll give us the coupon rate.
I have a question about the relation between, like, how do you, like, I punched in the right numbers for number 4, but like I don't understand how the present value and like the payment and like all those numbers could give you the N. Like, how does that let you calculate the amount of years left to maturity?
So if you have, you think about a different way to say it. You put all those numbers in? Okay. And did you get N and you just don't know why you got N, or you didn't get N?
I got N. I just like, I don't understand like the relation between like, how did I get N?
So how did you get N? So what's happening here, I just want to make sure I was clear what question I was answering. What's happening here, and then Matt, I'm going back to number 3 in a moment. What's happening here is that we're figuring out what is the timeline that would produce a present value of 9722. So there's only, in order to get a present value of 9722, you have to have a certain mix of cash flows and a certain yield. So if you have, basically what it comes down to is how, if we were thinking about the present value, I'm going to do it as a present value equation, not an annuity equation, so it just doesn't look too ugly. But for any given cash flow, if you know what the cash flows are, and you know what the interest is, and you know what the present value is, you can solve for N. So what we're doing is saying, we know what the yield is that we're getting. The question is, how many payments and how long until that final N would it take to give us this specific yield? So basically it's, you have all the other variables, you can solve for N. Think about that for a moment and I will come back to it. So up here, when we solve for payment, we're going to get 21599. That is the payment we're getting every 6 months because it's a semi-annual payment. So in order to figure out the coupon rate times face value equals the annual payment. So we multiply this by 2 and we get 432. So 432 equals 10,000 times the coupon rate. Divide that by 10,000 and you get the rate. Vivian, how you doing with that?
I feel like it's just the wording. Like, I understand, like, in the equation that you can isolate n and you can solve for n, but it's just like the way it was worded.
Okay, so how many years are left to maturity? Maturity is this number right here. So we want to know how long until we're getting that final payment and how many coupon payments. How many periods are left when we're going to get a payment, and when is that last payment?
Okay, I think I get it. I get it. It's just like, I feel like,
This is one of those things that you don't get by staring at it. It's one of those things, like you find your car keys in your peripheral vision, but when you're looking at them, you don't see them.
I think it was just like the new like concept of bonds. It kind of like relates to like everything we've learned before. I just kind of forgot. And
So
now I
here's
get it.
the thing. It is totally new words. And that's why here's where my finance lab is really a good chance to just repeat it and repeat it until it gets familiar. So find some, you know, the my finance lab problems that are not long problems, that are a little bit more straightforward. Do the similar problem thing and repeat them 2 or 3 or 4 times, just so you start getting, because what'll happen is if I gave you this problem and kept saying, okay, let's imagine it's trading for 95.34. You would literally just start changing one number in your, eventually you would begin to say, okay, I just have to change that. I just have to change that. You start getting used to the structure of the problems. And part of it is you want it to feel more comfortable. Comfort, the more comfortable it is, the easier it is to relax and absorb it. And getting comfortable with the structural stuff between now and Thursday makes it easier to do that. On Thursday, we're going to do a lot more with looking at what happens when interest rates change, what happens with different structures of bonds and things like that. So getting comfortable with just doing the basics will make Thursday a lot easier. All right, everyone, turn off your videos, give yourself a 5-minute break, and at 10:25, we will go over exam problems.